GameStop investors, welcome back. I hope everybody's having a great weekend. In the last video, we talked about the no exercise early theorem, something nobody is talking to you guys about. And in that video, I had a little Easter egg on one of the slides, a very important point that I didn't really talk about because it's getting its own video topic today, its own coverage. And that is another thing that nobody's talking about. The hedging of warrants by institutions. Boy, I know you probably didn't know that was a thing, right? Remember the hedging of the bonds, the delta hedging, the shorting of the underlying stock? It's going to happen with the warrants too. In today's video, we're going to talk about hedging warrants. Stick around if you're one of those people that wants to learn absolutely as much as you can so you can understand how things could go over the next 12 months, at least to understand the mentality of institutions and how these finance bros are trained. Let's get right into the details. I know some of y'all think I'm crazy talking about no exercise early. It is a real thing. It's a theorem that has been taught to finance professionals, finance students since the 1970s. And guess what? So has the hedging of things like bonds and warrants. In fact, I'll share a little personal story with you. As I was finishing up my no exercise early video, I called my son who's finishing up his master's degree in finance and accounting at one of the top business schools in the country. I said, hey, GameStop is issuing warrants. Do you know about this no exercise early theorem? And what was his first remark to me? He said, yes, I know about it. In fact, we just talked about it in our corporate finance class last week. The next thing you do is short the stock, short the ticker. That was his answer. Hedging by shorting the ticker to protect your warrants is something that people are taught. It is a real thing. It's being taught even today at top business schools in the country. So I want you to realize I'm not trying to drive any narrative here other than educating you guys on what institutional investors are likely thinking, both about the bonds. We've had this conversation about the bonds many times. We're going to have the same conversation about the warrants, and I'm going to give you a couple of tangible examples so maybe it sinks in. Why do these guys short the underlying ticker if they're bullish on something? Why would an institution hedge a bond or warrant by going short? I would refer you to the quote from Warren Buffett that I have on the screen here. Risk comes from not knowing what you're doing. Hedging, when done right, is like buying insurance for your investments. It lets you sleep at night while keeping the upside. And GameStop is handing a free gift to all of us, to the institutions, and they are not going to let that gift just evaporate. They're going to protect that gift and protect the potential upside. In the last video I put out for you guys called No Early Exercise, I'll put a link up here if you haven't watched that one. Go watch it first before this video. We talked about why institutions are not likely to exercise these warrants early. For American style options or warrants, which GameStop's warrants are, early exercise is generally suboptimal because you're leaving the time value on the table. The more profitable strategy is either to just sell the warrants instead of exercising so you can capture both the intrinsic value and the time value, or hold them. Hold them is another completely valid strategy. But institutions, if they decide to go the hold route, are likely going to hedge the warrants to protect the gift they were given and protect their upside. There are multiple ways to hedge a bond position or a warrant position. The most common method is the one we're going to talk about today, shorting the underlying ticker. And if you're wondering what is the dilemma here, why don't they just hold the warrants? Why do they got to hedge it? Warrants are like a lottery ticket given to all of us by GameStop. They have a large potential value, especially if the company grows and has better results over the next year. But the outcome is uncertain. None of us can say with 100% certainty which way it's going to go. And so an institution is going to want to protect that potential value with the proper hedging strategy. A second correlated question that you might have is if the warrants were a free dividend given to all of us, then why even hedge when you're holding them? And it's because hedging manages the risk of that gift you were given. It has value. You know that the warrants are going to have value the day you get them. If the stock were to go down, that value evaporates. So hedging manages the risk of stock price declines, impacting that value. It manages the volatility risk over the next 12, 13 months of holding those warrants. And it reduces the opportunity cost of holding an unhedged position. If you've taken the economics or finance class, you know what I'm talking about when we talk about opportunity cost. Much like hedging for convertible bonds, the hedging of warrants is going to be a dynamic delta hedge. You're going to go out and look at the delta of the bond or the warrant. You're then going to short the ticker, a percentage of your holding, depending on what the delta is. You don't go short the entire position. You short a percentage according to the current delta of the bond or the warrant. The institution will collect cash from that short position. They sold shares, they collect cash, and most likely they will invest that cash in a risk-free vehicle like T-bills, making, I don't know, 4.5%. Then we get into the dynamic part of it, monitoring the delta for changes and adjusting the hedge up or down as delta changes. I'm not going to bore you with a bunch of math. You can go do that work yourself if you're truly really interested in testing out everything I'm showing you here. But let's go over some potential outcomes and how an institution who is hedging their warrants would come out in these various scenarios. Scenario number one, GME drops to $20 by the expiration date of the warrants. Scenario two, GME moves up, but only to the exercise price of around 32 bucks. And scenario number three, GME soars. You could pick whatever number, but for my math example, I calculated it at GME runs up to $40. On the next slide, I have the actual breakdown, but let's just cover how these different outcomes would look to an institution that hedged their warrants. If GME drops to $20, and they hold the warrants all the way to expiration, they are still going to make a profit, even though the warrants expire worthless, because that short hedge will generate a profit. In the second scenario, GME moving up to $32, not quite enough to exercise, just right there. The result for an institution with a hedge, a delta hedge, would be a modest loss because the warrants expire worthless and they lost a little bit of money on their short hedge. In scenario number three, where GameStop runs up 40, 50, whatever you want to say, 60 bucks, we're using 40 here. That would also be a profit for the institution, even with their short hedge, even as they increase their hedge as the stock price goes up, just like they would in a convertible bond, because they have these warrants and those warrants are going to grow in value. So they'll have a loss on the short hedge, they'll have a profit on the warrant. And at the end of the day, what did they do? They gave themselves two different scenarios where they make a profit, even if the price goes down, thanks to this gift from GameStop of the warrants. And the worst possible outcome for them is that the stock just trades flat or only has a modest gain up to $32. When I ran my numbers to generate the table at the bottom of this slide, I just want to go over the assumptions that I'm using. And in the interest of simplicity, we're going to consider a theoretical institution, a bondholder that bought all the bonds. And so they're getting all 14 million of the warrants that are being given by GameStop to the bondholders. The reality is there are other institutions that are not bondholders that are getting warrants because they're stockholders. And the second reality is it's not one institution that bought all of the bonds. There are different institutions that are bondholders. They could all have different strategies. I'm just trying to keep it simple for the sake of this example. One institution holds 14 million warrants. The institution has an initial hedge based on a 0.25 delta of 3.5 million shares. See how that works there? 14 million warrants with a 0.25 delta. you only need a hedge of 3.5 million shares. As the delta goes up, you increase your hedge. The third assumption is what I just said. It's a dynamic hedge. So as the share price increases, you increase your short position on GameStop stock. Same thing that's happening with the bonds will happen here with the warrants. And they will take the money that they earn from shorting the stock and invest it in this assumption case. They will invest it in a risk-free return like T-bills, earning 4.25% over the next 13 months. Those are the assumptions I made in running my calculations of how would the outcomes be for an institution employing a hedge on the warrants. The table at the bottom tells the tale. If the stock price drops to $20, the adjusted net profit over here, because of their short position, even though the warrants, the gift they got, ended up being worthless, they protected them by shorting the stock. They come out ahead almost $28 million, a profit in that scenario. If the stock ends up around $32, they're going to lose money on the short hedge. They'll make money from the interest they earned on the cash that they got from shorting. And the net outcome is a negative $20 million loss. The third outcome, if the stock price runs up to 40 bucks, they make a massive profit on the warrants. They lose a little bit of money on the short. And I even included some extra shares going short as the share price goes up. So the amount of money they lose on the short goes up compared to this first option. They made money on the interest. The adjusted net profit for that final scenario, $66 million. If you're looking at these three outcomes and saying to yourself, there's no reason for them to face a potential $20 million loss, why not just not do a hedge? Because the other two outcomes provide a considerable added profit. And these institutions that we're talking about are ones that hold convertible bonds. They've already got a hedge strategy over there. Being given these warrants kind of messes with the hedge that they have going on. It makes them more long and they have to balance everything out. It's all about getting a strategy in place that provides you the best chance at an optimal outcome, although nobody can guarantee that every outcome is going to be profitable. In this case, if the stock price goes down or if it runs up, the hedging that they put in place will ensure that they make a profit. In this video, I'm having you consider how a convertible bond holder who gets the warrants might be looking at this trade. Realize there are other institutions that just own GameStop stock. They don't own bonds. I think that they're going to be looking at no exercise early and hedging strategies also. So, look, I can't predict exactly what is going to happen with volatility on the stock or the bonds. My basic thoughts remain the same based on observing a half dozen or so other companies that do these warrants as a dividend over the last 5 years. Hint, hint, the next video coming up, I'm going to go through those half dozen companies with you. But I think the most likely outcome is that initially we'll have some movement up in the price, some unexpected volatility, and then things will kind of norm out after a week or so, unless GameStop has some news. And look, they're sitting on almost $9 billion of cash. I think it is reasonable for us to expect that they have some news planned over the next 13 months. I sure hope so, because you have these warrants sitting out there. If there is news catalyst that drives the price up, everybody is a winner. Like the very first video I said about these warrants in GameStop, Ryan Cohen's thinking, I win, you win. If the news is good, everybody is a winner. In the meantime, right now, social media is just kind of like the Wild West, with people making up all sorts of things that they think are likely to happen. Maybe some of them will, maybe they won't. But if they don't happen, I want you to reflect back on some of the videos that I'm going to put out for you over the next couple weeks. Just like when I talked to you guys prior to the GameStop stock split, social media was going crazy with theories, and I was trying to urge a little bit of common sense, saying these theories don't really add up. And we ended up being right, not the people with all the crazy theories. So will I be right this time? I don't know. I don't know. But I'm going to share this information because I want you to know how finance bros are trained. I want you to know how they think. I want you to know what I believe they are likely to do. And really the spark to light things on fire here beyond what we expect is the unknown from Ryan Cohen and GameStop. That's what we're all here for at the end of the day. In the meantime, regarding the warrants, just use common sense. Keep your head on your shoulders. Don't take speculative bets unless you're willing to accept all of the risk and all of the potential losses or gains that come with it. Because I want to see you guys make money. I don't want to see you crying in the streets about crime because you didn't understand all of the potential ways that this could go. If you have any questions or comments, leave them for me down below, and be sure and check back in the next day or so for part 3 of this little series on warrants as a dividend, where I will be going over in detail half a dozen other companies in the last 5 years who issued warrants as a dividend, how it worked out so far for investors and for the companies. And I think you're going to be surprised to see a lot of the stuff that we talked about in the last video and in this video are going to be demonstrated in actual results, data sets from half a dozen other companies. So make sure you're subscribed to the channel, hit that alert button so you don't miss the next update. I am Tony DeNaro, and I will see you on the next video.